What's going on, investors? Sean here with Everything REI, and in this video, I'm going to give you a comprehensive guide on all things hard money lending. If you guys are new to this channel, welcome. My name is Sean. I'm a real estate investor, hard money lender, and real estate agent based in the Bay Area. And on this channel, we go over real estate investing tips, strategies, and current events to help you become a real estate investing boss. As a hard money lender, I take calls from you guys all the time about the common questions that new investors have about how to use hard money loans. So if you guys are new to real estate investing and you want to get into your first fix and flip project, but you don't know where to start, then definitely watch this video all the way through. If you guys have any more questions after watching this video and you still want to learn more about hard money loans, feel free to schedule a call with me. You can find my link down in the description below. Now, without further ado, let's hop on in. All right, so this is Hard Money Lending 101. We're gonna talk about fix and flip loans as well as a long-term rental loan program. So first things first, if you guys don't know who I am, my name is Sean. I'm a real estate investor and a hard money lender with Conventus Lending. Conventus is a hard money lending company based in San Francisco that helps people do fix and flip loans as well as 30-year long-term rental loans. I'm also a podcast host and a YouTuber. Welcome to my channel. The podcast is called the Everything Real Estate Investing Show with Sean Pan, where we have over 230 episodes of amazing guests who come on the show to tell us everything about their business. So if you want to learn more about real estate investing and you want to hear about industry secrets from the experts themselves, then definitely check out the podcast. You can find it on Apple Podcasts, Spotify, etc. And I'm also a meetup group leader. So if you guys want to find a great networking event, but you don't know where to start, check out my meetup group, meetup.com/everythingrei. So first things first, what is a hard money loan? Well, hard money loan is going to be defined as a loan based on the hard asset itself instead of on your borrower worthiness. So we're going to be looking at the property's value and how good of a deal it is versus on your debt to income ratio or your income and tax returns. Now there's two types of hard money loans here. We have the bridge loans for the fix and flip projects. This is typically what you would think of when you think of a hard money loan. Basically a loan to buy a property really quickly. It's going to be short term, just 12 months or so, and interest only. Now, because of this, it's going to be a little bit higher interest than you're used to. We're probably going to be in the 8 to 9% range, whereas for a conventional loan, you're probably going to be in the 3% range. Just know that's going to be a little bit more expensive here. Now for the long-term rental loan program, this thing is pretty new. The thing only came out about a year ago, but this allows us to have a 30-year fixed loan for our projects. So I'll go into a little bit more about why the long-term rental loan is really good. Just realize for now there's two different types of loans. You have your bridge hard money loans and you have your long-term rental loans. Now hard money loans are going to be somewhere between institutional financing and private money. So what I mean by that is with private money, this could be money from a rich friend, an uncle or family member, and they just trust you. So they're just going to give you the loan. They probably won't do any real underwriting on the property and they're just going to expect a nice healthy return. Whereas for an institutional lender, they're going to want to see everything about you, your documentation. They want to do full appraisals on the property, and they're not going to be very flexible with their terms. It is what it is. Well, hard money loan is somewhere in between that. We are going to be relatively flexible, but we still do professional underwriting just to make sure the deal is secure. Because of that, we're going to be cheaper than private money loans on average. And we're going to be similar to institutional financing where if you have more and more deals, we'll be able to fund them, no problem. Whereas for a private money lender, maybe after 1 or 2 deals, they'll be tapped out and they won't be able to give you more loans until you pay them back. So again, what we're going to cover in this presentation, on the bridge side, we're going to go over the common misconceptions, who should be using hard money loans, the process of getting a loan, the required documents, what construction loans are and how they work, as well as the cost of using a hard money loan. And then on the long-term rental loan side, we'll talk about the different types of long-term rental loans, prepayment penalties, debt service coverage ratio calculations, how to calculate your interest rate, the limitations of the long-term rental loan program, seasoning period and how you can use it for the BRRRR strategy, and then finally, how to get cheaper hard money loans in general. So starting with bridge loans first, let's talk about the common misconceptions of a hard money lender. So misconception number 1, people think they can get 100% financing from their hard money lender. In general, the highest loan to value that a hard money lender will give you is 90% of the purchase price, possibly 100% of the rehab costs for more experienced investors. No real hard money lender will want to give you 100% leverage because it's just too risky. If you have no skin in the game, you can easily walk away and then leave the lender holding the bag. Now misconception number 2, I can get a private lender to cover my down payment and closing costs. So again, we don't want you to be in a situation where you can easily walk away. If you have a private money lender that's going to be part of the deal, we don't generally want them to be as second possession lenders. We'd rather have them be equity partners with you and also sign on the loan as guarantors. So number 3, some people think that credit doesn't matter if you're getting a hard money loan, but hard money lenders still do run credit checks, and we want to make sure that you don't have a history of being negligent with your finances. So for example, if you've been foreclosed on in the past, or you have a bankruptcy and it's pretty recent, there's a good chance that the hard money lender won't give you this loan. And number 4, some people think that there's no appraisals needed for hard money loans. Well, depending on your lender, sometimes they will need to do an interior appraisal. So when should you be using hard money? Hard money loans are great if you can't qualify for conventional financing. Like if your debt to income ratio is too high. As an example, when I first flipped my first project, I already had a big loan for this primary residence here in the Bay Area, and I had a bunch of loans for other rental properties out of state. So to get another conventional loan for a bigger house in Sunnyvale, it wasn't gonna happen. But I knew that the deal was really good, and I knew that if I could get this project and flip it, I could make a lot of money. So that's why I was able to use a hard money lender. They didn't care about my income. They just cared if I had enough money to successfully complete the project, and then they gave me a loan. So by doing that, we actually made a lot of money from that deal. But that wouldn't have been possible if the lender only looked at my qualifications based on my income. So if your debt to income ratio is already too high, then it's a good time to use a hard money loan. Hard money loans are also great if the property condition is too poor. So if the property is missing a bathroom or it's missing a kitchen, then a conventional lender, won't lend on it because the appraisal will say this is not inhabitable. And also if you have too many loans. So if you have between 0 and 4 loans, it's pretty easy to get a loan. 4 to 10, a little bit harder, but then past 10, the bank just won't give you a loan anymore. They're gonna think you're too risky and they'll let you, figure things out on your own. Hard money loans are also great if you need to close quickly. We have a lot of clients who have a cash flowing property, but conventional financing will take 30 plus days. So they use a bridge loan like ours to close the property quickly while refinancing into a long-term debt solution. So we can close within 10 or 14 days. It's super convenient, and that's what they use us. They also use hard money if they want more leverage. So most banks are limited to 80% of purchase price, sometimes 75% for duplexes to fourplexes. So if they want a little bit more leverage to buy the property, fix it up and sell it, they can use a hard money loan because again, for more experienced investors, we can go all the way up to 90% of purchase. And on top of that, we can also fund the rehab budget, whereas most conventional lenders won't give them that. But hard money loans are not for everyone. As you can see here, we cannot lend on owner-occupied properties. So if you plan on moving into this property, then a hard money loan is generally not for you. Usually, hard money lenders can only invest in properties that are used for business or investment purposes. And that's because of the way their license is done. So we just can't lend on owner-occupied properties. Plus, in the worst case scenario, it's a lot harder to get a property back from someone who lives in the property versus someone who just has it as an investment. Like I mentioned before, we also don't do 100% financing. And generally speaking, we want to see that people have above a 620 credit score. So the next question people ask is, how do you get a hard money loan in the first place? Well, you would find a hard money lending company that you want to work with, and you would call a loan officer. In this case, you guys can all call me. My number can be found in the description below. But you would call me and say, hey Sean, I want to get a hard money loan. And the lender would ask you some questions. They're going to ask you questions about the property, and they're going to ask you questions about yourself. So about the property, very common things. What's the address? What's the purchase price? What's the rehab budget? What's the approximate ARV? ARV stands for after repair value. Basically, what's the home going to be worth after you're done repairing it? Then we're going to ask about information about you. What's your previous experience been like? What's your approximate credit score? How much money do you have in liquid reserves? So liquid reserves means cash or stocks. We also want to know your prior experience. And in our company, we define experience as properties that you've had under title over the past 3 years. So if you're an investor, you've been buying properties, you have a lot of stuff, but they're in an LLC, that's okay. As long as you can prove that you're an over 20% owner of the LLC, then you can get credit for all of those projects as well. But let's say you're a general contractor and you've worked on hundreds of deals over the past 3 years, but you were never a key partner there. Then unfortunately that wouldn't count as any experience because you're just following someone's direction. You're not the one actually putting in the risk and analyzing the deals to make sure they make sense. So in that case, that wouldn't count as any experience, but that is something still to note that we can possibly help you with. People also ask me all the time what kind of documents we need. So one thing to know is we do not need your W-2s and we do not need tax returns for hard money loans. However, we will be doing a hard credit pull. So make sure you're not trying to refinance or purchase another property at the same time, because when we do a hard credit pull, that might mess up that current loan you're dealing with. Now, if you're buying through an LLC, then we're going to want to see the documents, like the articles of incorporation, as well as the operating agreement to show who are the managing members. The processing team are also going to want to see your bank or financial statements to prove that you have the liquidity to successfully complete the project. They're going to want to see enough funds to cover your down payment, your closing cost, your rehab cost, and at least 6 months worth of interest payments. Basically, if you don't have any of these, then it's unlikely that you're going to be able to successfully complete the project, and you're just going to end up running out of money in the middle of your project, which is not something that we want to have happen. We're going to want to see your driver's license or ID, obviously the purchase agreement that lays out all the terms. We're going to want to see the title prelim, and as well as get your escrow contact. We want an insurance contact, and we want to see the scope of work to see what kind of work you're doing on the property. Now, if you're getting a construction loan or you need help with your rehab, then this slide applies to you. Now, the first thing that we're going to want before we even start the process is the scope of work from your general contractor. This is going to be a line-by-line item of all the work and costs associated with your rehab project. The second thing we're gonna do is send that scope of work out to a third-party company to do a feasibility study. Now, the feasibility study is going to review your contractor's scope of work and make sure that the numbers aren't too far off from expected values. Like, some contractors will rip you off and write crazy high numbers. Some contractors will also underbid. And as an investor, you have to think, if they underbid me now, does that mean they're gonna just upcharge me later? So we wanna make sure that these numbers are legit, and then we approve them. And the third one is called the draw process. So this is gonna be when you're in the middle of your project. The draw process is actually how you're gonna get paid your rehab funds. So at closing, we don't just give you 80% of rehab budget on day one and say, hey, good luck, have fun, do whatever you want. What we do is we have you break down your job into different milestones. And at the completion of each milestone, we're gonna send an inspector over, they're gonna take photos, you're gonna show us that you did the work that you said you're gonna do, and then once all that's approved, we're gonna wire you back your rehab funds. So an example, let's say your rehab loan is for 80% of a $100,000 estimated construction budget. So we don't just give you $80,000 on day one and have you, do your project. In fact, we hold on to $80,000, and as you complete each milestone and you request a draw, we'll then reimburse you 80 cents on the dollar that you spent so far, up to $100,000 as you complete the project. So that's how the draw process works. So it actually takes about a week from you initially make that request until you actually get the money back into your account. Here are the general costs of doing a hard money loan. In general, you have your rates. Your interest rate is going to be 8%, 10%, typically interest only. Now, this is a yearly interest rate. So you're not paying 8% per month, but you're paying 8% over the whole year, but you are making these monthly payments on that interest. Your origination fees, also known as points, are going to be around 1% to 2% of the loan amount up front. So if your loan amount is for $1 million, then your origination fees are going to be $10,000 at closing. Your processing fees here are going to be between $999 and $1,500. And then there are appraisals. So sometimes some hard money lenders will also charge you an appraisal on top of processing fees. So that can be between $400 to $700. Then, like I mentioned in the last slide, if you're getting a construction loan, your feasibility study will be for $650. If you are buying in an attorney closed state, your legal fees are going to be between $700 and $1,000. Servicing fees are going to be between $15 to $100 per month. And this is because most hard money lenders outsource their servicing. They don't handle payments in-house. They originate and then they give it to a servicing company to handle all the payments. If you're doing a rehab loan, then your draw fees are going to be around $265 per draw. And some companies also have a prepayment penalty, typically going to be around 4 months of minimum interest. So that means that even if you finish your project 1 month in, you're still going to have to pay the interest on the other 3 months that you didn't use. So whether you finish on day 1 or on month 4, you have to pay the same amount of interest. Our company, Conventus, does not have prepayment penalties, so feel free to use us if that's something that you want. Okay, so here's an example of a deal. Let's say your purchase price is for $500,000 and your loan amount is for 80% of that. So your loan amount here is gonna be $400,000. If interest is at 8.5%, then the way you calculate the yearly amount is by taking 8.5% by $400,000. So that ends up being $34,000 per year or $2,833 per month. Points is going to be 1 point. So 1% of 400,000 is $4,000 of points. You have $1,500 for processing fees. You have $30 a month for servicing fees. And assuming your project times for 4 months, the total cost of using hard money will be $16,953. And this is pretty easy to calculate. What you do is you take this number, 4,000, you add your processing fees, 1,500. Then you take your interest, 2833, add your servicing, 30, and then multiply this number by 4, and then you get 16,953. If you guys are confused at all, feel free to leave a comment down below and I'll be sure to answer your questions. Now that was a lot already, but we're gonna keep going on because this is gonna be a comprehensive guide for how hard money loans work. So next thing we're gonna do is talk about the long-term rental loan program. So the long-term rental loan program is a game changer. This is a 30-year fixed loan that has no income verification or W-2s that are required. And so this is great for investors who have hit that debt to income ratio cap or who have over 10 loans. So people who hit the DTI cap, these are gonna be a couple of people. So one, you're a Bay Area investor like myself, where you already have a lot of properties and you already have a lot of loans, but your income isn't enough. Like, you only make so much from a day job, but you can get so much in loans. Some investors are also entrepreneurs, or some investors just don't have any jobs and they have all of their income from the rental properties. But because of the way real estate investors think, we wanna minimize our taxes, right? So we basically show that we have no income. Now with no income, it means you pay less on taxes, but it also means we can get no loans. So that's where this product really shines. It helps the people who cannot qualify for conventional financing. Now, before I go into this, I'm gonna make it clear. If you can still qualify for conventional financing, go for that for sure. Those are gonna be the lowest interest rates with the most favorable terms, no prepayment penalties, no extra processing fees or origination fees. You can basically get a 30-year fixed loan for around 3.5% and not deal with any other headaches. But If you can't get conventional financing, then this is your next best thing. So in this case, our rates can go as low as 4%. And again, this is great for purchases or refinances of properties that you already have equity in. So there's 4 types of long-term rental loans. You have your 30-year fixed rate, 5-1 ARM, 7-1 ARM, and 10-year interest only. So the 30-year fixed rate, very standard. It's just 30 years for the fixed interest rate, and you're gonna be paying off that loan over that time. The 5-1 ARM and 7-1 ARM stands for adjustable rate mortgages. So your first 5 years are the same rate, it's fixed, but then every year after that, it changes. Same thing with 7-1 ARM. First 7 years are fixed, then every year after that, it changes based on some index. Now, the 10-year interest-only option is very interesting because it's still a 30-year fixed loan. It's just that your first 10 years are interest-only. So you're actually gonna be able to cash flow a lot during those first 10 years. And then your next 20 years, that's when you pay off the loan. Now, instead of qualifying these loans based on your debt to income ratio, we base it off something called debt service coverage ratio. And this basically tells us if the property itself can cash flow. Now, the way that we calculate DSCR might be different from other lenders, but the way that we do it is actually very generous. It makes so that people can easily qualify for it. The way that we do it is we take your gross income and then we divide it by your PITIA, also known as your principal, interest, taxes, and insurance, and association dues. So if you look at this example right here, let's assume that the rents are gonna be for $1,500 a month. And your mortgage payment at 5.5% a year is for $852, property tax at $250, insurance at $80, and HOA dues at $75. So if you add all these numbers up on this column here, you get $1,257. And this is your PITIA, and no matter what, like no matter how efficiently you run this property, you always have to pay these no matter what. So if this ratio is under 1, no matter what you do, you're not going to be cash flowing. So this ratio should be above 1.15 to qualify for our best rates. In this case here, the DSCR is 1.19, and so it passes. Now, one thing that's unique about this loan is that it has prepayment penalties. By default, it's in 3 years. So for 3 years, you're not supposed to sell or refinance this loan. And the way that the penalty is based on is on a step-down basis. So on year 1, you pay 3% of the loan amount. On year 2, you pay 2%. On year 3, you pay 1%. Then after year 3, the prepaid penalty period is over, and you can just do it. As an example, if you had a $100,000 loan amount, then on year 1, you pay $3,000. Year 2, you pay $2,000. Year 3, you pay $1,000. After year 3, no more prepay penalty. Now what you can do though is you can tweak these prepayment penalty periods. So if you want a lower rate and you don't plan on selling this property for 10 years anyway, then you might as well go for this 7-year minimum interest version because it lowers your rate by 0.5%, which can make a huge difference over the long term. Now, what's the rate? Pricing these out are actually pretty complicated because as you can see here, we look on the credit score versus your LTVs. And by doing this, we're able to price you and make all these little adjustments. Basically, we're gonna be able to customize these loans for you. If the initial rate you get isn't something that you like, we can opt for you to buy down the rate with more points, or we can have you go for a stricter prepayment penalty period so that your rate goes lower as well. Typically, most of my clients try to go between 4 and 4.5% for their 30-year fixed loans. Now, there are also some limitations for this long-term rental loan program. The first one being that, obviously, it's not for owner-occupied properties. Even if it's a 5-unit property and you live in 1 unit and you rent out the other 4, we still can't lend on this property. You also need to have experience with this loan program. So you must have owned property within the last 2 years to qualify for this. But this experience can also be your primary home. So as long as you've had a home in the last 2 years, you can qualify for this loan program. And let's say you're buying a property and you can't qualify for it. What you can do is buy this home first with a bridge loan and then refinance it into a long-term rental loan with this program. The properties here need to be in livable condition. So like I mentioned before, with bridge loans being able to help you buy a property if it's missing a kitchen or bathroom, for here, that's no longer the case. These properties need to be in livable condition from day 1. And first loan, we can only go up to 8 units. So 1 to 8 unit properties only. We also have a $75,000 minimum loan amount, but we prefer to have the minimums be over $100,000. And for this loan program, we also want to see a 660 credit score or above. So seasoning periods are something that's pretty unique. This is going to determine how much money you can start pulling out and the time period that you have to wait before you can pull out the money. So from 0 to 3 months, the max cash out refinance shall be capped at the lesser of 70% of loan to cost or 70% loan to value. From 3 to 12 months, the max cash out will be between 100% loan to cost or 70% of loan to value. And after 12 months, it's going to be 75% loan to value. So this is kind of complicated, but I'll explain more on the next slide. Loan to cost basically means the loan amount divided by the total cost. So purchase price plus your rehab budget. So as an example, and this is what people are doing right now, doing the BRRRR method using hard money loans is using this program right here. So the purchase price is for, let's say, $200,000. Let's say you're renovating for $30,000 and your ARV is $350,000. So if you add up $200,000, which is your purchase price, plus $30,000 your rehab costs, then your total hard costs are $230,000, right? Pretty easy. Now, if you go from month 0 to month 3 and you're trying to refinance out, then you're going to be limited to 70% of your hard costs. So 70% of $230,000 is going to be this number, $161,000. But if you wait until after month 12 to do your refinance, then your only real limitation is the percentage of your ARV. Like, we don't care about the hard costs anymore, we only look at the ARV. And that's why you can pull $245,000 here. So as you can see, based on where you are and what you're trying to do, you can pull out 3 different versions. It just depends on how long you're willing to wait. Most people only want to wait up to month 3 and pull out their initial capital, and they let the rest just sit in the property as extra equity. So here are some ways to get a cheaper loan. So the first one, as a bridge loan, number 1, get a higher FICO score. Get a lower LTV. The less leverage you need, the better rates we can give you. Having more experience and repeat business with the same lender is also amazing. Now, of course, this one right here, negotiating. I shouldn't be saying this, but of course, if you talk to multiple lenders and you get multiple bids, then you can go back to us and say, hey, this guy's offering this, can you match it? And for the most part, we can. So definitely give me a call and we'll see what we can do. As a long-term rental loan, the higher the FICO score you have, the better. As you saw in the chart a couple of slides ago, for every 20 points, the rate goes down by a little bit. And for every 5% that you need less of LTV, the rates go down as well. Having more experience helps, but really buying down the rate and opting for a stricter prepayment penalty is probably going to be your best bet, because you can buy down the rate very easily. You pay 1% upfront to get 0.5% down on your rate. And going from 3-year prepay penalty period to 7 years also drop your rate by about 0.5%. Well, I hope you guys all enjoyed this video. This was definitely very long. If you guys have any questions at all, you can email me here. My email is sean@everythingrei.com. Instagram can be found at I'm Sean Pan. My phone number is here, but I suggest you use the Calendly link to schedule a call, because that way it's gonna be nice and scheduled and I can take the time to talk to you. And here's also my YouTube channel. And if you guys did enjoy this video, do me a quick favor and take 2 seconds to smash the like button to let YouTube know that you guys enjoy videos just like this one. And if you have any questions whatsoever about the hard money lending process, drop a comment down below. I read every comment and answer every single one, or schedule a call with me with the link as well. And if you haven't yet, I highly encourage you to subscribe to the channel to watch more videos about real estate investing and to become a real estate investing boss. Thanks so much for watching, guys, and I'll see you next time. Take care.